Hi, everyone, and welcome to our first weekly market update. The plan is to provide you with a quick update on the markets so you know what's happening. And we will be doing this on Mondays at 9:30 a.m. London time. Let's begin. If you do have any questions, if you do join us live, then just leave any questions now, or if you're watching a recording of this, then you can just leave questions and I will come back later during the day to provide an update for you. Okay, good. Before we start, I need to stress that derivative products are leverage products and can result in losses that exceed initial deposits. Of course, we're sharing our updates here, and it's our personal opinions and ideas. The idea is to provide content to educate and support you in your trading. But obviously, at the end, you're all responsible for your own trading. And it's really important to highlight all of this because a lot of the influencers, a lot of people publishing content online, obviously promise unlimited gains with almost no risk. But the reality of trading is that it is not like that at all. So who am I? Well, my name is Alejandro Zambrano, and I am the Chief Market Strategist here at ThinkMarkets. I've been Chief Market Strategist for many different companies. I've been in the industry for many, many years. And let me share my insights. So, what happened last week? Well, gold hit a new all-time high on Tuesday. That's after Philly Fed Services missed expectations. Euro USD, which you've probably seen as well, have been soaring pretty much all of last week. It's not too far away from the 2023 highs. So we have some interesting and clear trends, which is sell dollars and maybe buy euro, maybe buy pounds, and definitely be buying gold and silver. Silver is picking up as well. So that's sort of where the action is. We do have, of course, higher stock market indices, but they are better, I would say, to some extent, pricing in the issues that we are seeing in the markets. So what are the issues? Like, why is gold up? Why is Euro USD up? Well, take a look at this third bullet point here. So as we know, we have non-farm payrolls, and that's an estimate, but they also recalculate the figures when they had more and better data, and they actually revised the numbers strongly. So initially, they thought that the US economy would have produced 2.9 million new jobs in the last 12 months. Instead, it produced 2.1 million, which is obviously significantly lower than the 2.9 projected. So that would be lowering the monthly numbers with about 68,000 jobs, which is obviously quite a lot if you think about it. Um, so the market obviously doesn't like this. This is signs that the labor market is not doing too good as anticipated. In fact, it was the largest downward revision since 2009. What else? We had the FOMC meeting minutes. So there's been speculation when are they going to cut, yes or no, and when, and by how much. And what's interesting from the minutes that a majority of the members thought it would be good to cut rates in September. So they were already getting ready for this. And this is really important. The majority of the members or participants said risks to employment goal had increased, and many noted risks to inflation goal had decreased. So the Federal Reserve has two goals. One, make sure that everybody that wants to work can work, and number two, that inflation is not too high. In other words, it's not above 2% for too long. Now, it has been above 2% for a very long time now, but they're saying with their help of this is that, okay, inflation is the risk that inflation is going to be too high for longer is diminishing. It's less risky. On the other hand, it's now more risk that people lose their jobs and can't actually work, the ones that want to work. So they're shifting gears now. So inflation, while important, is going to be less important. What's more important are the initial jobless claims that have been quite poor recently. What's more important is the non-farm payrolls, not necessarily that inflation is high. Because if you look what some banks are saying, they think that the unemployment rate can go from the current 4.3% to about 5.5, maybe 6%. And that's why stock markets are so wobbly, and that's why people are buying gold, and that's why people are buying the euro against the USD. To top it off, on Friday at 3 p.m. London time, the head of the Federal Reserve said time has come for the Fed to cut rates. And that obviously pushed the euro USD even higher. So that's what's happening right now. I don't think it's going to change dramatically over the next couple of days. This is still what going to be what people are focusing on in the next couple of weeks and months. At one point, of course, and this can happen, is that if the data from the US and maybe the rest of the world becomes really poor, then people will still buy a bit of gold. But I know it might sound a bit confusing, but they might buy dollars at that point, and they would in particularly short sell things like the dollar yen. The dollar yen would continue to go down. So that's something to bear in mind. But we're not there just yet. So about the data then, the US manufacturing contracting for a second month in a row at 48. That's what we had last week. And then we also had European manufacturing contracting. The only thing that did better than expected was UK manufacturing and UK services. That's good. So maybe the UK, well, it's telling us the UK economy is doing slightly better than expected, which is obviously great. Maybe we could potentially buy some pounds. And this is interesting. The unemployment claims were as expected. So not a major change, but still not great numbers. So let's take a look at the data, and then we'll take a look at what to focus on for this week. Okay, so this is your USD. We published this update on TradingView. We mentioned it as well in the weekly articles. We do produce weekly articles. You just head to thinkmarkets.com. You'll see an article in about 2 hours' time based on this information. And we said at that point last week or so that we said a break to 109.64 can take you up towards 112.23, which is the target based on this wedge. And we are very close to that level. So soon, I think we're going to see some profit taking. But I think as long as you trade above 110.95, which is the low, not from Friday, but from Thursday, as long as you're above that low, yeah, we might come down a bit. But I think people are probably going to be buying the dip here, targeting 112.23 and 112.74, which is that high from 2023. If you break that high, you have to go quite high up until you reach the next major level. Here's the dollar yen. So the dollar yen, had a very nice sweet uptrend over 2024. You see, it gave back all of its gains, and the reasons for this is straightforward. Bank of Japan is looking to raise interest rates, and in the case of the US, they're looking to cut rates, and as well, the US economy is not doing good, and that's why we're trading lower here. So we are creating lower and lower highs, and this could possibly turn around here because if you look at stock markets, they did something similar and then they went up to some extent. They didn't go back to 2024 lows, but you get the idea. And they are highly correlated. So either stock indices like Dow Jones, the S&P are wrong, or the dollar yen are wrong to some extent. To some extent, because obviously this is a currency pair and the other one's a stock indices. But I would argue that we're probably going to go a little bit lower and try to bottom out here and go upwards again, maybe to 152, maybe 156 in 2 to 3 weeks' time. For now, it's still bearish and look for a break to 147.12. Take that out and then possibly can go upwards again. Here are crude oil prices. We keep an eye on them, but they're not really that interesting right now from a pure trading perspective. At least I don't find them too interesting because we're stuck in a big range and the market doesn't really have, it's not really respecting levels. For example, I was watching 81.65, having that as a trend defining level, and we pushed above that, and then we still dropped lower. And last week we're trading here, and I said we're gonna go down, and now we're up again, which is okay. So going up maybe to 80, 81 and a half, sorry, 80 and 81, and then maybe from these levels possibly go down. It's a bit tricky here with the situation just happening in the Middle East. You probably read the news. There's more tension this weekend, and this probably going to continue for a bit. Well, there will realistically be more tension there until we have any sort of resolution. Um, so I will be very, very careful, but for now, bearish below 81.65. All right, this is gold prices. This is very, very super straightforward, very easy. You have an ascending triangle. You got resistance here, here, and here. And we did an update on this, I think, on TradingView as well as the weekly articles. And we said a break here can lift you higher. Triggered here, went up, and then we went back to the breakup point, but we're trading above the breakup point. So as long as we're about 2,461, we go down. I think people are going to buy, targeting 2,579. This target is based on this pattern here. And this is the NASDAQ 100. So you can see here, went down strongly and then went up strongly. And now it's taking a bit of a break, which is perfectly normal. You know, we gained quite sharply. And the way I would look at this, I say if we take out 19,952, we can go up to 20,398. Whereas if we trade below 19,444, we might trade a little bit lower, maybe to 1940 on a bit of profit taking, because maybe at one point we need to correct this move here. And this is actually, it says ETH, but it's actually Bitcoin. So Bitcoin is very, very straightforward here as well. Um, what you're looking at here is inverse head and shoulders. Difference from here to here, it gives you this target of about 10%. And we triggered the break here. And if we go down towards that breakup point, but do not trade below 60,396, I think we're going to go to 65 and then 68. And if we take out 72, then guys, we are probably going to resume that very long-term bullish trend. So what do you want to keep an eye out for this week? Well, today, Monday, you got durable goods orders at 3:30 London time. This is interesting because of the narrative that maybe the US economy is slowing down. So if this is weaker than expected, maybe gold up, Euro USD up, and stock market's down. On Wednesday, we have Australian consumer price figures. That's obviously interesting if you're trading Australian dollar. And remember CrowdStrike? You know, they put a halt on um, uh, several US airlines, and also here in Europe, we had the flights being down, trains being down, hospitals, the UK being down because of CrowdStrike. They are reporting earnings. So if I wanted to speculate on that, one could take positions before the event or after the event. Bear in mind, both CrowdStrike and Nvidia can have easily sort of 10% moves on the earnings. So that's out on Wednesday. On Thursday, we got UK GDP, which is not that interesting because it's data from the second quarter, but to some extent, came with markets. Then you have jobless claims, which you definitely want to keep an eye on. And then on Friday, you got consumer price index. Remember, we talked about the dollar yen, so you got consumer CPI from Tokyo. That could definitely be something to move the dollar yen to some extent. And then we finished the week with Eurozone consumer price index. Everybody's interested to know when are they going to cut rates, right? So obviously, if we go down to 2.3, that's going to increase the likelihood. But I do suggest to keep eye on core inflation. Core inflation is still a bit too high at 2.8%. And if you look at um, the unemployment rate in the euro area, it remains at very, very low levels. So people are working and they're not really getting fired yet. Uh, and the service sector of the euro area economy is doing okay. Manufacturing is not doing too good. But long story short, I don't think this is going to change too much. So we are going to have cuts from the ECB. The question is by how much. But that's out. Gonna keep an eye on that. And then you have consumer price index from the US, or PCE, personal consumption expenditure, and that's the Fed's most important figure. Um, Up until now, the headline figure has been at 2.5% annually, and core has been at 2.6. So obviously, the Fed thinks it's going to come down, okay, because otherwise they wouldn't be getting ready to cut. And this is because the unemployment rate has been weakening. And with that, we're gonna wrapping up. If you do have any questions, just drop them in the comments, and we will come back to them later during the day. Join us next week for the next market update at the same time. Thank you.